All right, I'd like to introduce our next speaker, Jordan Dawley. He is actually a Bend native, which makes him a rare species. There you go. So Jordan is the senior manager in the Jones and Roth Bend office. He holds a dual degree in accounting and economics from the University of Oregon. Any other ducks out there? One? Any beavers? All right, don't get animosity if you're a beaver. Actually, we are at a beaver school, so sorry, duck at a beaver school. Jordan specializes in strategic tax planning and advisory services for individuals, families, and closely held businesses across a wide variety of industries. As an active coach and advisor, he enjoys helping his clients navigate complex transactions and achieve their short and long-term goals. Jordan is passionate about supporting the Central Oregon business community and providing solutions that make a positive impact on both the companies and their owners. Currently, he serves as audit chair for the Bend chapter of the Risk Management Association, which is an important role.
That's very important.
Very important role. Outside of the office, Jordan is devoted to spending family time with his wife and daughters and enjoys hockey, kayaking, and hiking, sorry. I'm the bike person. Today, Jordan will share his experience or expertise on tax rebates, incentives for builders, developers, and commercial buildings. I'm really eager to learn more from Jordan. Please join me in welcoming you.
Thank you so much. Wow. This might look weird. I understand this is a dead mic. It works for like their Zoom stuff, so it might seem weird. Yeah. So, but I want to start by saying, yes, I'm a Bend native. The first accounting class I took was up at COCC, and I don't think I've been on campus since. So it's a little weird kind of coming back and realizing that like a lot has changed, right? And the other thing I realized is I have the least ideal time to present, right? I am what stands between you and your lunch. Y'all been here for a while, so thanks for being engaged. Please ask questions, right? That's what makes this all work. We'll dive into it, but before we do, very important disclosure, right? Obviously, these opinions are mine. They don't represent any kind of legal binding decision. The second point is actually really important. It's intentionally vague, some of the things I talk about, because everything in tax law is based on your facts and circumstances. So it's very rare that I'll give you an absolute if you do have a question, and I encourage you to ask questions, okay? So my understanding in the setup of the conference is there are individuals talking about 45L tax credits, which is the residential development credit, as well as 179D, which is the commercial clean energy production systems credit. So I'm not going to go into those credits in great detail. I'll talk about them a little bit. It's the bottom two that I'm really going to spend a lot of time on. The ITC and the PTC come from the IRA. I feel like I'm ready to wrap, right? We're all about acronyms here. It's actually quite obnoxious because the IRA, of course, for many years was the individual retirement account, and then they introduce it as some kind of tax bill. So I'm annoyed by that, but you don't have to be. So let's talk a little bit about these credits. So 45L, as I mentioned briefly before, is the builders of new energy efficient homes. It's a $5,000 tax credit per home. Again, my understanding is there's somebody who's going to deep dive on this in another session, so I don't want to step on any toes. As to nuances there, that's kind of the generalities on how it works, the standards you got to meet in order to qualify there. 179D, again, as I mentioned briefly, is related to energy efficient systems in commercial buildings. Again, someone else is going to deep dive on that and how you can get that maximum deduction amount per square foot. Okay. So man, we are moving quick. Y'all are excited because lunch is getting closer and closer. So let's keep chugging along. The investment tax credit, I like to think of them mainly because I have to talk about them a lot. The ITC and the PTC, as the ITC has the initial credit. And what I mean by that is this credit is based on the installation of qualifying equipment, right? And so you get it up front, whereas the production tax credit, the PTC, is based on the energy production of that system, okay? And you have a couple important decisions to make on those credits that we'll get into here. So I like to think of tax law really as social engineering, right? So what they're trying to do is incentivize certain behaviors, good behaviors and bad, right? Things not to do and things to do. And to do that, right, there's a tax benefit or penalty to do so. So they're encouraging with the ITC the installation of renewable energy systems available to residential and commercial communities alike. and it can cover up to 30% of the installation cost. I'm going to talk about a little bit later how that can be 70%. There's some bonuses that can come into play, but I'll talk about that in a little bit. The most common applicable technologies is solar, wind, geothermal. There's some other kind of nuanced qualification ones that I admittedly don't have great knowledge of what those systems are, like how they function, how they work, but there are others available if you're interested. How do you get the credit? It's pretty easy. It goes on your income tax return. It's a non-refundable credit, right? So that credit you generate offsets your tax liability up until the point that you had a liability. If you did not, it rolls over to the next year. Different systems in play. I know I had a question just before I got started on nonprofits and direct pay. How do they get paid, right? Because of course they're tax exempt. So what's their incentive to do this? We'll get into direct pay here in a little bit, okay? All right, so another important kind of clarification is you need to own the property that these systems are installed on, right? Renters are not eligible for this credit, right? So it's the property owner who gets that. And it's specifically on new systems installed. Modifications to existing systems cannot generate this as a new credit. I already jumped the gun on the income tax liability offset and the fact that it is not refundable. I actually had a client this year. I'm always talking this year as it was last year. But in 23, they installed solar panels. They came in with their documents like, hey, we did solar. We're getting a $7,500 credit refund. I'm so excited. Well, their tax liability wasn't enough to get the full amount. So we do the returns. I call them, hey, we're all squared away. They come in, they said, well, where's my refund? I said, well, it's $6,300. Well, where's the other $1,200? Well, you didn't have tax liability. You got to wait next year. Well, the solar people told us we're going to get $7,500. So it's really important to understand kind of how that works functionally. I guess the last clarifying point, right, is that it's got to be in the U.S. or a U.S. Territory to qualify for this credit. The tax basis you use in calculating that credit, it should seem somewhat obvious, right? It's the inputs, right? The equipment, labor, permitting fees, expenses directly related to installing that qualifying system. Those are what qualify for that up to 30%, potentially 70% of the credit. So these rules, I broke it out here, are for projects that are greater than 1 megawatt, MW, that's megawatt. I always want to say milliwatt. I think it's megawatt. Projects below 1 megawatt, which is basically a small project, automatically qualifies for 30%, right? Larger projects, again, over 1 megawatt, has to meet a couple requirements, right? You get a base credit, and we're going to talk about the larger projects now. You get a base credit of 6%. To get the 5-time multiplier, right? To get up to the 30%, you have to meet 2 other very important requirements. Prevailing wage requirement, the people that work on those jobs need to be paid prevailing wage, which is established, right, in terms of what those are by locale. So you need to look more specifically at where you're doing the project and what that prevailing wage is. Then there's an apprenticeship requirement. There's a certain percentage of the employees, the total labor hours that need to be done by qualified apprentices. Let's see, next page. Okay, so what is the prevailing wage requirement? Well, you're going to do it or you're going to get penalized. Is kind of the long and short of it. You're going to look at the locale. I think Oregon is the Oregon Bureau of Labor and Industries, has the chart in terms of key functions, you know, building kind of construction roles, if you will, and what the requirements are in terms of the percentages. So you got to look at locale. So if you do work elsewhere, check with the local agency in your area. Now, if you don't, that's like kind of that social engineering we talk about. If you don't meet that prevailing wage requirement as a contractor, you've represented you have, the penalties are strict. It's $5,000 per worker, as well as back pay to that worker, plus interest. So that's not good. And then if they find that you've intentionally disregarded this rule, it's $10,000 per worker and 3 times the back pay owed. So pretty clearly, it's just obvious if you're going to represent to people as you're doing these projects that you meet this requirement, make sure you meet that requirement because it's going to be pretty painful on the back end for you. Okay. Any questions there before we move on to the apprenticeship stuff? Yes. I beg your pardon? I don't off the top of my head, unfortunately. Yeah, I looked before I came in this morning, and I know it's on the Oregon Bureau of Labor and Industries. Yeah, you look there. Okay, so apprenticeship. I always think this is great. Apprenticeship is a great thing to get people skilled in different trades. So prior to 2023, it was a 10% craft hour rule. It increased to 12.5% through the end of last year. 2024 onward, effectively, it's a 15% requirement. Okay. And again, DOL spells out rules. There's applicable state level programs as like what are the ratios of apprenticeship to journeyman, how that works. The DOL is the one who specifies like what is an apprentice specifically. And it's defined there, right? It's an incremental wage based on experience and skill. There's 2,000 hours or 1 year of job training, minimum 144 hours of in-classroom instruction, and then one-on-one mentoring and supervision, okay? There's a ratio you got to maintain. So the ratio specifically is determined by when the project's started, and then the state apprenticeship program specifically. There's some roles when I was looking. There's some roles, and I can't remember which off the top of my head. Like electricians, it's a 1-to-1 ratio. People who run heavy equipment, it's like a 1-to-5. So you just need to be specific to the role that they're doing, what the ratio is for that specific function. Okay. Direct pay, I'm going to catch the gal in the back's attention. Direct pay, we chat about this a little bit, right? So this is a non-refundable tax credit. So the obvious thought would be, well, gosh, if I'm a tax exempt agency, how do I get a benefit for doing a qualifying project like this? And direct pay is your answer. This is one of the rare instances where a description from the IRS is very clear. It's directly paid to you, right? So that's a beautiful thing. There is, so typically, I know there's an individual back there from the city of Redmond, municipalities, nonprofits, other tax exempt agencies would need to pursue it in this manner to get paid for the credit that they're generating. There's a pre-filing authorization process where you register the tax return. Your Form 990 indicates, hey, we are eligible and applicable for direct pay. And as we talked about before, you're effectively requesting reimbursement via direct pay for that installation project. They obviously still have to be eligible projects, which I like to make very obvious statements sometimes. The other thing that I think is quite interesting is this is one of the few tax credits. There's 11 energy tax credits you can actually transfer. So there's a possibility, depending on your kind of bylaws or whatever your agency allows. There's potential. You do a project, you generate a credit, and you could sell that credit to an unrelated third party. And potentially, instead of pursuing direct pay, you could sell the credit. Ironically. That is very important, though, is that it's got to be an unrelated third party, right? So you have board members and people who have direct beneficial, kind of involvement in that activity go and get the credit, right? That would it'd be shady. So don't do that. Any questions? Yeah. Yeah. It's for the installation of the project, right? New build, and you're talking the like shell, everything's being done, and then there's a component like an installation of a solar related project. Yeah, so it would just be related to the installation of the qualifying project specifically, right? You'd carve that out. Yeah, yeah. Yes, ma'am. Yeah. Oof. I will, I don't know that answer specifically. That's a great question. I do know, we'll get into here just like the PTC is that production related credit. And you specifically on one installation, like one solar panel project, you can't get ITC and PTC. You pick one or the other, what's going to be most lucrative. What's interesting though, is you can on the same property, you can do a co-location. You can do PTC and ITC out separate units. The one that I think of, I have a lot of clients that are very interested in storage units, right? You guys probably all heard this. It's like the craze. I know there's financial advisors in the room that would agree that like people are crazy about storage units. It's wild. There's like more storage units than there are people in the United States. It's like crazy stats. But what I kind of envision when I'm thinking about this, like say you had a storage unit and you want to install solar panels and pursue this credit, that would qualify for the PTC or the ITC. But you could do something like an energy storage system, basically backup batteries storing that clean energy you're generating. And that would qualify for ITC, but not PTC. So if you catch my drift, you could install the solar panels, take the PTC credit, and then install an energy backup system and take the ITC credit. So same property, two credits, but they're co-located. So I don't know specifically back to your question on the meters and how that specifically parses out. I'm assuming if it's same ownership across those different buildings and properties and it's one general project, I would imagine there's an aggregation, but I don't know for certain on that. Okay. All right, so production tax credit, again, pretty aptly named. It's based on the production of renewable energy and your ability to sell that back to the grid or unrelated parties. It's a credit for doing so. Again, there's multiple ones there. The most common would be wind, solar, geothermal, and biomass. I knew of geothermal being big in like this Southern Oregon area. I feel like I'm a little bit ignorant growing up in Bend that I didn't realize geothermal can be done pretty high level here. Is anybody? La Pine's good. That's wild. I feel like that's like the coolest concept, like drill into the ground to just get your heater cooling from that, right? It's kind of a cool thing. What's that? There you go, trench. Yeah. There you go. So you're not getting to the core, darn it. But no, that's a good point. Yeah, it's a fascinating. That's why we're here, is to learn, right? I appreciate that. Yeah. Interesting. Okay, perfect. So back to the credits based on the per kilowatt tax credit, right? Based on what you're selling back to the grid or an unrelated third party. The duration of the credit is 10 years. So once the system's installed, you have a 10-year period that you can generate this tax credit. Again, it is the same treatment as the ITC that is a non-refundable tax credit. Again, so it offsets tax liability, not refundable. Prevailing wage and apprenticeship comes in again over that one megawatt kicker there. So this is a nice chart. I don't know, it's kind of hard to read. I don't know why I put it in there, but hopefully it kind of spells it out. The whole idea is what we're showing is below 1 megawatt, not milliwatt. The base tax credit is a full 30%, and the maximum on the PTC is 2.75 or $2.75 per kilowatt hour. And these wage and apprenticeship requirements are not applicable. It's only when you get into larger projects, right? And same thing, you get a reduced base amount, and then once you meet those requirements, it's basically a 5-time multiplier on the credit you'll be able to get. Okay, so those work similarly. I've always been a fan of the radio business. I thought I'd do one of two things when I was coming up as a youth. I thought I'd either be a teacher. I always thought teachers were fantastic, and then I thought, I would love to be on radio. I don't know what it is. I always thought radio was great. So I gave you a radio tease early on. I said, well, the credit max is 30%. But then I said, well, you can get up to 70, right? Anybody remember that? Anybody paying attention? So the way you get it to 70% is there's 3 bonuses to this credit. The largest of which is if you are able to install a system in what they define as a low-income housing community. And that bonus is 10 to 20%. So you can get it to that 20% if you meet the rules of that program. Like the qualified opportunity zone, I imagine, I did not look this up, so I apologize. It's done by the Housing and Urban Development. They have a lot of data sets in terms of what's, nationally, what is low income and what's not. So that's up to 20% of that. The other one is sourcing a material. If you're able to source steel or iron or other components of the work you're doing domestically in the US, you get another 10% bonus on the project that you're doing. The last one is what they call an energy community bonus. That was an intentional stall there. Does anybody know what an energy community is in their kind of the way they spell it out? Has that been familiar at all in anyone's terms? A little bit? Yeah, you might know. Do you want to share? Ah, yeah, that's a beautiful description. I kind of set you up there. I apologize. It's a little different definition in the tax law. What they're trying to do, again, that social engineering is they recognize, not, and this isn't a political statement, but they recognize there's certain subjects that are political grinding points. One of which is disadvantaging communities that used to be on old power systems like coal, right? The large amount of jobs and stuff tied to old coal plants. So what they're saying is if you install these type of projects that create work in communities, energy reliant communities is kind of the more specified term, not necessarily to your project as you've described, but it's more like, hey, if you come in an area where the coal plant was closed and a bunch of jobs have gone by and you come in with new projects that creates jobs, we'll give you another 10% credit. So that's kind of the trade-off there. So add the 20 for low income, add the 10 for energy, the production sourcing of the material, and then 10 for if you can do it near one of those energy disadvantaged communities. you get to 70%. Okay. So that could be pretty good. All right. So, but it all depends. I don't know. I'm honestly not aware of an area in Oregon that would qualify for that. Perhaps there is one, but hey, we could do work elsewhere too, right? Oh gosh, that's disturbing seeing my head on screen every time. So I'm going to open this up. I know lunch is so close. Y'all have been so good, so engaged. Any questions I can answer for the group here? You got one. Don't call on you. Okay, that's good. Okay. I know I felt like that was quick. That was like speed dating. We just ran through it, So hopefully this is helpful information for y'all. I know there's a lot of other great stuff to kind of shed light on at the conference. You had a question. Oh. So when you say the 10% bonus in lower communities, does it have to be No, it doesn't have to be like low income housing. It's in a community defined as low income. I think the whole idea there is you're going to bring projects there that, has a need for workers to do them. And the kind of whole idea is you'll bring the work with them and potentially help them level up, if you will. So, yeah. That mic work at all for those folks on Zoom? We should have checked at some point. I apologize. If nothing else, it's probably better that they don't hear me yet. We're on. So, hey, appreciate y'all coming. Thanks for being engaged. Hope you have a good rest of the conference. Thank you so much.